So up next, we've got a panel where I assume we're going to be prognosticating on the future of Regulation A. Moderating the panel, my friend Steve Nelson from Continental Stock Transfer. Also as panelists, we have Dina Rochkind from Hastings, Jillian Sidoti from crowdfunding lawyers Trowbridge and Sidoti, and Marc Deschenaux from Deschenaux, Hornblower and Partners. Okay, thanks.
Great. Thank you, Steve. Good morning. I think Steve adequately described the panel, the future of Reg A. My name is Steve Nelson. I am the president and chairman of Continental Stock Transfer and Trust Company. Incredibly, we are now the oldest and largest U.S.-owned transfer agent in the United States, and we've been in business for over 50 years. We have a large share of the IPO market generally, and we are very dominant in the SPAC space in particular. We also have a footprint in the Reg A market, both as escrow agent and as transfer agent. And we are very happy to sponsor again this year. And I will let each of my panelists introduce themselves and give a little bit of a background. Dina?
Thank you very much. I'm honored to be on this panel. So my name is Dina Ellis Rochkind, and I work at Hastings in the fintech and payments practice. Most of my business is really in lobbying, but also some legal work, mainly in the crypto blockchain distributed ledger space, which is very connected with Reg A. Unlike what I would say is, I mean, I think our whole panel, we're all lawyers, right? Mm-hmm. So unlike most people, I spent most of my career on Capitol Hill writing the laws, and then everyone else goes and messes them up. So as I said, I spent most of my time on the House Financial Services Committee and the Senate Banking Committee, and I was involved with almost every major banking law over the last 2 decades, including something like e-sign. E-sign made electronic documents and signatures legally binding, and there was a lot of fear during that time, and I think we're going through something like that right now. But most notably, I was the lead on the Jobs Act in the Senate, on most of the provisions of the Jobs Act. And the Jobs Act is very interconnected. Obviously, we're talking about Reg A, which I worked for Senator Toomey. We were the lead on Reg A. So the Jobs Act is very connected to what we're talking about today, but also is very connected to sort of the whole blockchain, crypto, DLT space, where there's this pent-up energy to make changes to the securities laws or make it easier for retail investors to participate. And then before I stop talking here, I'll just tell you 3 fun facts about the history of the Jobs Act. One is Reg A was completely non-controversial, and none of us at all I think even were thinking about retail investors or real estate for that matter when it passed. 2 is that the Reg D, or the getting rid of the ban on general solicitation, it was not our intent for the SEC to then make it very difficult to determine whether somebody was an accredited investor. The idea was to make life easier. And this, lastly, I'll mention that if it weren't for Wawa, Wegmans, and W.L. Gore and other Main Street companies, there would be no Jobs Act, because they were the main drivers. They were companies that were hitting up against the shareholder limit and have great brands, and were really the ones who were on the ground and able to push the Jobs Act forward.
Great. Jillian.
Hi, I'm Jillian Sidoti. I'm not nearly as interesting as my counterpart Dina over here, but I'll try. I have been working as a lawyer since 2006, and prior to that, I was in real estate development, and I was raising money for our own deals in doing condo conversions in San Diego. And when the market dropped last time, I started practicing law, and the natural transition was to start helping issuers figure out how to raise capital for their deals. So I have been doing Reg A offerings specifically for real estate estate since about 2010, before the Jobs Act passed. I did the big, huge paper filings. It was a massive pain in the butt. And so I was incredibly excited when Reg A passed. And so our firm focuses on Reg D and Reg A offerings for a variety of industries. The majority that we represent, of course, are real estate, but one of my clients is actually speaking this afternoon in Site 2 Biologics. They're on a panel. I think they're the last panel of the day. So that's what we do, just really help the little guy try to raise capital for their deals.
Marc?
I'm Marc Deschenaux. I'm the founder of Deschenaux, Hornblower and Partners. I have a triple education, first in computer science, then as a trader in securities and commodities, and then as a lawyer in Switzerland with two specialty in common law and in continental law. I've been a house counsel for the largest investment entity on the planet for for a little bit more than a decade. And my specialties are to organize IPOs and private offerings. I was involved in about 169 IPOs and about 240 private offerings.
Wow, that's awesome.
Great, thank you. So why don't we kick it off with Jillian? I don't think we've heard much about marketing efforts, so tell us what you think are the most effective marketing methods for Reg A offerings, and how do we get more investors in these deals?
Well, I think the thing about the clients that I've had that have been really successful with their marketing efforts, they always give something before they're looking for something from the investor. So for example, one of my bigger clients, he had massive amount, actually my two biggest clients, both had had set a foundation of educating their base through the internet, using Facebook, LinkedIn, Instagram. That's what they did. They educated their investor base about why this asset class or this industry was a good industry in the first place, as opposed to saying, hey, invest in our deal, we're offering 10% return on investment. So it was like, here are the statistics, and these were both real estate companies that I'm referring to, but I can even refer to a biotech company, not in Site 2, but another one that also employed the same methods. You know, here's what's happening in the industry. This is why this industry is important. This is where the trends are going. This is why this kind of investment opportunity is the right investment opportunity at this time. And started with that. Through social media, and when their Reg A hit the market, it was like shooting fish in the barrel. They had already, for lack of a better term, conditioned the market to understand that this is what the investor should be investing in. So if anybody wants to check some of those out, one of them is Grant Cardone Capital. If you look him up, you can see some of his marketing efforts. And another one, for another point of reference, was BioLife. They did a lot of, you know, what they're attempting to do is 3D print a heart. And so they started off with talking about, you know, how to 3D print tissues, how this is going to work, what the market looks like in biotech now, and started with educating the market before they hit the market with an offer.
Okay. Any perspective on how we get more investors in these deals, or do you think we've reached a critical mass?
Oh, I hope we haven't reached a critical mass. I mean, I talk to, like, I'll use my aunt, for example. You know, she's in her 60s, and, you know, she's like, I don't know what to invest in. Well, you should look into some crowdfunding opportunities. What's that? I mean, that's a very typical thing to hear, and I don't think that's just, you know, a woman in her 60s. I think that transcends generations. I think there's a lot of people who don't understand that there's a marketplace out there other than the stock market where you can put your money. So,
I get that. The
yeah.
question is, how do we reach them?
How do we? Well, I think it's social media. I really think whenever somebody tells me, you know, at a crowdfunding conference, oh, I hate Facebook, I'm like, learn to love it, like figure it out, because that is the future of where things are going. And it doesn't have to necessarily be Facebook, but you have to learn to love some medium, whether it's YouTube or Instagram or LinkedIn. Telegram. Yeah.
WhatsApp.
Yeah, yeah. So you got to learn to love something and get really good at it, because that's where people are. That's where people's faces are on the screen, and that's what they're looking at. So if you're a company out there trying to do a Reg A and you want to reach the masses, you got to start with social. You got to start with social media.
Great. So Dina, given your legislative background and sitting here years later, what's gone right and what's gone wrong with Reg A versus what the congressional expectation was and your perception of what the SEC was looking for?
Sure. So I want to start by saying that it was really interesting listening to Jillian, because the first folks that came in to lobby me on Reg A, it was the biotech industry. Yeah. So that is somewhat what I was envisioning, and I see it here right now. But I think the things that I think it's great that Reg A applies to retail investors. It's an alternative to Reg CF, which is much narrower. I think that the biggest problem that I'm seeing with Reg A right now is there's a ton of interest in the blockchain distributed ledger space and tokenization, which lends itself very well to crowdfunding. But every single Reg A+, even if it's just a typical Reg A+, and even if the disclosures are well done, if the issuer is using blockchain technology, the SEC is not approving any of those Reg A+. And so my theory is, I call it the FIRE theory. So I think Marty's heard it before, he's in the audience, but the FIRE theory is you had this ICO craze, which clearly retail investors are interested in investing in different types of assets, but there's still a FIRE that is, there are a lot of retail investors that are holding a lot of tokens that may be worth nothing. And so therefore, I think the SEC is moving very slowly on anything in the Reg A+ space, because they are fearful of any more exposure to retail investors. That's very unfortunate, because I think retail investors, especially younger people, want to be in the space. But I think that to get any kind of traction on Reg A+, it's probably going to take a lot of push from industry. Maybe potentially push Congress to push the SEC to let some of these things go. So the holdup is and this continued fear of the retail investor losing money. Now, I know why that fear is out there. That fear exists when you're the SEC chairman for two reasons. One is when retail investors lose their money, it gets bad press. Two is, once it gets bad press, you get hauled up to the Hill to explain yourself what the hell happened. So it's unfortunate, but I think I think the future is bright for Reg A+. It's just going to take some time to work through those issues and change that mindset about investing in startups and private companies.
So having been down at the commission just this week and meeting with the commissioners and the chair and the staff, my perception is what I think you're saying, that they're not anxious for there to be a lot of movement on blockchain and token offerings, et cetera. I'm interested in your perception of whether Clayton is plus or minus on this issue.
I think he's both plus and minus. I think he's been very tactical in terms of the issues that they have, how they've addressed certain issues, and they are very cautious, not in terms of just retail investors, but they're cautious because they are concerned about missing something in terms of understanding the technology. So they've been great in terms of being open door. They're doing a roadshow, and then they have their forum at the end of this month. There are three things I would point to two make sense, the third doesn't make as much sense to me. The Ether Delta, going after Ether Delta, the exchange, to me, that was very pragmatic because it was a small exchange and there were only 64 people that owned ERC20, so it had minimal effect. It's possible that, I would say the penalty was not high enough because it didn't send a loud enough signal to the market that a lot of these exchanges are not operating legally in the US. Two would be the Hinman speech that declared that Ether is not a security. Again, very tactical for three reasons. One, a huge lobbying effort. Two, if you would have said Ether was not a security, it would have been very disruptive to the marketplace. Three, you would have wound up hurting retail investors more than the folks that did the original offering and sold the private shares. And the Hinman speech is silent to those things. The last point I'll make is the framework. The framework that just came out and the no action letter. The no action letter is, not very meaningful. I don't know if Turnkey started that, maybe they were asking for more or it was just an advertising thing. But clearly, I don't think they needed to get a no action letter from the SEC. But the framework, there are a number of things the framework does, but it says in it twice very prominently that a security can potentially turn into, they don't say utility, which I hate that word utility, but a good or service. And to me, by putting that statement out there, it sends this, my question is the SEC doing that so it can preserve its option to do more action letters? Or is the SEC doing that because it really thinks that a security can morph into something else? And to me, if a security can morph into something else, then we need either an industry set or SEC, a better set of disclosures, because 2 years ago, I didn't wipe out my retirement funds, but I bought one Ether. I bought some other stuff, but I bought one Ether, and I didn't know what I had. I was like, do I have equity in the infrastructure of Ethereum? That'd be awesome, because it's the biggest one out there. Probably will continue to be. Or do I have one Ether? So I do think that that framework needs a lot of clarity. And if you go out to California, you'll see there's complete confusion from that framework.
There's complete confusion in California in general. I know, I live there, so.
Yeah, so I mean, there is complete confusion in California, but to respond to you, the first time I went to California, I thought, oh my God, everything that everyone's saying is illegal. When I started first going out there for business. But then I realized that, no, this is we talk about fintech sandboxes, right? Well, there's a reason for California and the way, it's one big beach. So the SEC, targets the baddest. We are basically, Silicon Valley, California, other parts of the country are big sandboxes where, the SEC and the other agencies pick and choose, and they usually go after the low-hanging fruit.
Mm-hmm.
Okay, let's pivot a little away from the West Coast and let's go international. Marc, what are the possibilities of selling Reg A Plus deals, Tier 2 deals, internationally?
They are very important. Actually, I was very interested by what Jillian was saying a moment ago, because according to my book and according to my figures, Facebook and LinkedIn and all social networks are doing very poorly in basically selling securities and in convincing people to sell securities. I would like just to make a small test. Can anybody here in this room raise their hand if they already bought a security that they saw advertised on Facebook, LinkedIn, or anywhere?
Oh, I bought something, yeah.
So that's 3 people. That's great. So it's probably a trend to come. If basically internationally, first, to answer the question specifically, there is a huge possibility to sell Reg A+. And there is a number of reasons for that. Number one, a lot of the foreign exchanges don't look at the type of US registration that there is. They just say, if this stock is listed on the New York Stock Exchange, well, it's going to qualify to list on Euronext or London Stock Exchange or any one of the European exchange, number one. Number two, the limitation to 50 million is a US limitation. So you could effectively have, and that's, I verified this before sitting in front of you and telling you that, you could have, at the same time you have your Reggae Plus for 50 million in the US, you could raise 100 million, 200 million, 400 million from European markets, totally legally. The third thing that there is, I think, a big interest on is that if you want to hit the big market, if you want to really sell your securities and not just advertise them, what you'll need to do is convince institutional investors, because that's where the big money is. Actually, 92% of the market is institutional investor today, at least in equities and in US equities. And so if you focus on that figure, and if you want to tap into that figure, all you need to do is simply have your registration made in a multiple listing. There are a couple of issues with going international. And sometimes, and I don't want to get into all details here because it would be really bothering, but sometimes you'll have to file at the same time a Reggae Plus and S registration. And those two forms can make the file a little bit heavier. But in terms of success, it's quite a different result, because when the Europeans are not the top purchaser or are not early adopters, as you would say, they are very good followers, and they have a strength of purchase that I think would be hard to match in the US. US are more risk takers, are more, going with faster in the deal. But I think Europe is better to sell stock. And when I was a trader, we were always trying to get 10% of the issue initially sold in the US, and 90% was sold in 1 or 2 days in Europe.
Wow. Interesting. All right, back to you, Jillian. How does Reggae Plus meet up with state blue sky registration requirements and guidance from the state?
Oh, Peter and I were just talking about this. I will totally admit that I find the states so slow to move on getting these blue sky issues together that I've had things that were approved, and then the state came out with their blue sky laws, and my client and I would just sit there and look at each other. What do we do next? So, I'm finding that to look for a broker dealer who can help you with this is the way to go. Like that's actually the tact I've recommended to most of my clients, is either find a broker dealer that can help you with this, or figure out which states you don't want to be in, and then blue sky in all the other states. But with that being said, I am very vigilant about watching to see if any of these states go after Reg A filers, and I haven't seen any yet. I think it's just a matter of time with the bureaucracy of these states to catch up with Reg A before it will happen. So there's a risk. I think there's a risk reward with filing the cost of filing Reg A versus are you going to get caught by that particular state, and are they going to have enough teeth? Do you have enough investors there to go after an issuer?
Great, thank you. So Dina, getting back to the initial process on Reg A, the statute.
No, I'm talking about Tier 2. I don't do Tier. For anybody out there, Tier 1 is a massive waste of your time. Don't do it. It's a massive waste of your time and money.
So why would you be concerned about the time with regard to
That's a great question. So Tier 2 had the state regulators just now are starting to roll out filing fees for notice filing similar to a Reg D, which they're allowed to do. They are allowed to do that. Yeah, I have, and by the way, just to put your mind a little bit at ease, I have plenty of clients who haven't done it at all because it's been so slow of a rollout.
There's some preemption in tier 2.
Yeah, exactly.
There's preemption in tier 2.
Yeah. So under tier 1, you have to file, not only do you file, but you also have to get approved by that state. With tier 2, you file a notice filing similar to a Form D.
Okay, back to you. So the statutory language allows for a $50 million limit to be increased, and what's your view as to why that hasn't happened yet?
I should probably comment on why, you're probably like, why is tier 1 and tier 2, like why did it come out this way, right? So let me just say one thing about that. First of all, at that time I was in the Senate, so I blame it on the House. I've worked in both, but really.
That's very Washington of you.
It's very Washington, but the House negotiated most of it, and then when we just matched our language because we thought we had a better shot, and anytime I would get, NASA would call and they were opposed to the whole entire thing, they were the only opponent, every time they would call, and this is not to disrespect them, but since everyone else supported it, including President Obama, it was sort of like Snoopy, I'd be like, wah, 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 like they would be like so opposed, and I'd just be like, yeah. Sorry, so that's kind of why it wound up the way it did. Remind me of your question there. Oh, why haven't they moved it for greater than 50? So, Reg A Plus is supposed to be reviewed every 2 years, and the number can be, upped from more than 50. And I think it would be, even listening to the international side, it would be much more effective if it was at more of a 250 level, which nobody's talking about. But the reason it hasn't been increased has a lot to do with what I was speaking to about before, and that is that Chairman Clayton, and maybe again it's because of the fire, is very fearful of anything that affects the retail investor. So in this last go-round, Clayton joined with the 2 Democrat commissioners at the time and opposed raising the limit. And Hester Pierce and Mike Pewar, who both worked on Senate banking at the same time as me when I was working for Toomey on Jobs Act, put out a pretty loud statement opposing the stance that Jay Clayton took. My guess is it just depends on the next SEC chairman and who that is, and that the next one might be more willing to raise that limit. There's certainly pressure from Congress. There was legislation on the House side last Congress to raise it to 75, but there's just not been some of these changes that I think would be more meaningful in the capital formation space. It's hard to get them passed on the Senate side.
I just want to make a quick comment about, so I have always been, it's actually pretty depressing to me to hear that 92% of equity investments is held by institutions. The whole reason why I love Reg A, and you can find plenty of videos of me talking about this, is because the little guy can get into deals now. If you look at the statistics, anywhere from 90, depending on which statistic you look at, anywhere from 90 to 97% of this country is not accredited. So, they're these people, 90 to 97% of the country is missing out on some of the better deals out there. They're missing out on their neighbors, new fund, right? Because they're not accredited. So Reg A opens that up. So that's why I've always been a massive champion of Reg A, is because the little guy can get in. With that being said, I have to be honest, I'm a little opposed to it being increased, not so much because of Reg A, but because of Reg CF. And I'm afraid it's going to have a domino effect. And I don't want to see Reg CF go. I've seen some of the things out on crowdfunding platforms out there, the $1 million raises. I just saw somebody in here, sorry. The $1 million raises. And they're not, a lot of them are not well done. And I can see a lot of people losing money on those Reg CF platforms. And I'm afraid if we increase Reg A, there's going to be a push to raise Reg CF. And I just don't think it's right now. I think there's too much to lose for too many little investors.
See, and I would say on Reg CF that there's actually an appetite, if you had sophisticated enough lobbyists on Reg CF, I think there's appetite to make changes on a bipartisan basis to that part of the Jobs Act.
Sure.
There just is not, there continues, the lobbying on Title III was, was pretty unsophisticated. So it wasn't the Wawas, it wasn't Wall Street, it wasn't Main Street, it was the little guy coming in. And, they just don't have that ability to provide you with legal language. And
Right.
so I would say there's an opportunity there.
Mm-hmm.
Any questions before we proceed? So back to you, Marc. How can a Reg A plus Tier 2 offering finance a very expensive S1 offering as opposed to some of the low-end price deals that we've been talking about?
Well, first of all, we could say that in my experience, for an equal amount raised, Reg A is about less than a third, I would say, far less than a third, and sometimes in some conditions, about a fifth of the price of an S1 filing. But more than that aspect, what is interesting, I think, is that the Reg A has a better chance to finish in a smaller amount of time. And I think that most of the legal procedure do not have a good timing. They are too long and they are too heavy. I think that we also have another aspect with the Reg A is that we can basically define more or less in 6 months or in 4 months it's done. And I think for multiple listing, it's a big advantage. One of the points I wanted to comment on very quickly on what Jillian was saying before is I am also in favor of the little guy to come on the market. And the problem is that a lot of people don't realize that through their retirement savings, they are actually already on that market.
Right.
And so it's not only a question of them coming proactively. It's also a question of simply educating at school that whether you want it or not, part of your life will be determined by the performance of the stock exchange.
Right.
So, Dina, let's switch a little bit to tokenized securities. So why hasn't a tokenized security offering using Reg A been approved by the SEC in your view?
Yeah, I think I talked about this a little bit before. Again, it's the fire theory. So there's still a lot of people holding, tokens or digitized assets that are questionable and maybe worthless. And so there's exposure already on the retail side that's unrelated to a tokenized Reg A+, which may be may have very high quality disclosures, et cetera, but there's this concern I believe there's this concern in, while you have the fire burning, putting something else on the stove and increasing that exposure. I would extend that to that the more difficult thing that even as opposed to getting a Reg A+ approved is I think it's going to take even longer to see a Bitcoin ETF, because then we are really talking about Mr. and Mrs. 401k. We're talking about our retirement system. So I think that's why we aren't seeing the approval yet on Reg A pluses or Reg A's. I do believe that there are a lot of folks in Congress who would be very interested in having these Reg A pluses approved. And I don't know if there's complete awareness about the fact that there are so many of these in the pipeline that are not being approved just because of the underlying technology. And I want to just join with both of them. I am also a big believer in the little guy being able to invest in some startups, whether there are some limits to that. And it just seems to me that the timing is right now with what we're seeing we're having kind of, I call it a renaissance of startups, and we're seeing real use cases in the blockchain DLT space, and it would be a shame for retail investors to miss out on that. And I think that Jay Clayton, one of his signature things that he's going to leave behind is some kind of best interest standard. And if we are going to raise the standard of care for investment advisors, it just seems to me, if they have more of a fiduciary duty to the client, why wouldn't we allow some retail investors to invest in startups?
So I'll give you the answer to that question.
Oh.
The secondary trading market for these Reg A plus deals hasn't exactly been robust, and the market performance hasn't been robust. So, Jillian, what's your view of how that turns around, and if it doesn't, what happens then?
Well, here's the thing. When a client comes to me and says, I want to do Reg A and then I want to trade, I have a serious what I call it, I hope this doesn't offend anybody, come to Jesus moment with them, you know. So when I first started practicing law and I was doing Reg Ds, and then I got the opportunity to start doing microcaps. I think it was, I don't know, was it you and I that were talking about microcaps earlier? Yeah.
Yes.
So when I was doing microcaps, and none of them were successful. Not one is still existing today. They all tanked. You know, they couldn't keep up with the reporting requirements. They couldn't keep up with the costs associated with being a full reporter. So when a Reg A client comes to me and says, well, we want to do Reg A because we want to save money on, you know, be cheap on the reporting requirements up front, but then we want to get listed right away. Well, why would you want to do that? That's just, it's a pain, it's expensive. You're opening yourself wide open for pump and dump, for naked shorts, for all kinds of problems in the marketplace. So I just straight out tell people, I don't think that's a good idea. If you're not fully prepared right now to be a full reporter because you have some, you know, and you're revenue generating and you have all this great stuff, do not look to the secondary trading market as some kind of godsend, because it is not. It is anything but. So I usually, you know, you really have to have, you know, be revenue generating, really have a great shareholder base, a stock price that is higher than $5, and, you know, a great market maker. And if you cannot afford those things up front, and afford those things into the future, and you don't have a team in place to make sure compliance is there, you should not be you should just not be considering the secondary trading market.
Marc? What's your view on
He's going to totally disagree with me.
Well, the point is this, you know, in my opinion, every single of this procedure is a financial tool. And a lot of problems is today everybody wants to do everything. Yeah. So I'm sorry, and I'm also a lawyer, so lawyers want to be financial engineers. Financial engineers, you know, want to explain to people how to manage their wealth. I mean, everybody knows about everything. And when they don't, they just look at Wikipedia and feel that they are an expert the minute after. So I think we must come to reality. The problem is you will not substitute, whatever is the procedure you go public to, you will not substitute a sound financial engineering. And most accountants, with all due respect, don't know how to do that. The problem is you need to have people who know what they're talking about. That's one thing. Another thing is that a lot of these companies today want to jump to the end. They come, you know, they have $10,000 invested in the company, including their own vacation. And the problem is they come here and they want to do a multi-billion-dollar deal. And if they don't have a subject matter that can bear that, if they don't have, you know, the common sense of looking at what is realistic for them to do versus what is unrealistic for them to do, then I think, you know, we are in bad shape. Finally, I just wanted to make one last comment that I skipped before about raising the bar. In that, yes, I disagree with you. I think that we would be better off with a limit between $75 million and $100 million, because I think that it would save an area where basically today an S1 is still way too expensive, even for $100 million raise, with all due respect, because when you see what the project needs, what the costs associated with the S1 are, and what the costs of distribution of the issue are, it's really a moment when most projects that have a chance to survive and that will not tank like microcap will be in the $50 to $60 million arena. But if you already have $20 million worth of costs associated with the issue, and I'm overstating a bit and I'm exaggerating a bit, but you will not end up with a limit of 50 with anything more than 30. I hope I have made myself clear.
Dina,
I was going to say, I agree with you, because then a company is more sophisticated and better able to handle some of the legal costs and disclosures associated with a Reg A+. And there was something that you said.
Oh, about trading, secondary market.
Oh,
Yeah.
so, I mean, I would say to that, give it time. And I will be honest, I have a bias on it. I think it works well in the tokenization space. If we could ever get, I usually advise people that come to me, when they say I want to do a Reg A+ and I want to tokenize it, I usually say, well, you're probably better off doing a Reg D. If you want to do a Reg A+, then it's going to take a lobbying effort as well. You could hire me as your lobbyist on top of it. So I think I would say give it time as this whole area of tokenization continues to move forward and that technology becomes more sophisticated. And I do have a bias because I represent, Templum, which is one of probably 2 exchanges that has the ability to trade digital assets as securities. So I think the future, it's going to take time, but I think the future will see it.
Well, I'd like to say something, because this time I am disagreeing with you. The point is the following. I think that if now we are in a situation as we are, we cannot say just give it time to get liquidity. Give it some no-nonsense laws. Put a little bit, just like, I take an example. How about putting the pension fund with an obligation to invest at least 0.5% of what they have, in Reg A+ sector, or in, emerging companies less than 5 years sector. This kind of things, this kind of idea would create your liquidity. Liquidity doesn't happen by accident. Liquidity today is talking to the big boys. It's talking to the institutional investors. I don't like them as much as
like them.
But as much as you do. But the problem is, unless you want something to really happen, you've got to go where the money is and not where the hope is.
Yeah.
Well, I agree with you, and I would say in some ways we're saying something simpler, because making those types of things happen, you need to go talk to the leadership of the SEC.
Of course.
So you're saying basically you need somebody like me to go to the SEC and
totally,
visit
absolutely,
and push. I agree with you, and I think that the SEC would be doing a lot of those types of things if it weren't for the ICO craze, which threw them off track. Because Jay Clayton's first speeches were about making it easier to raise capital in both the public markets as well as in the private markets.
I had half an hour talk with Jay Clayton in a completely informal manner. And it was very interesting because he was very supportive of the new ICO coin and made a big speech about that. And then I asked him a couple of questions. I said, well, how about utility token? Okay, oh no. And by the way, I think that utility token are just another name for warrant. Okay, fine. And so how about utility coin. Well, it's the same as utility token. Okay, fine. And then the final discussion that we had was on a very specific point. It says, do you think there is liquidity in this crypto space in general? And answer was no. And the reason is very simple. Most of the liquidity is ensured by Bitcoin. And Bitcoin is still not the currency with whom you pay your rent and you buy your food. I know you can buy Lamborghini now. So if somebody wants to buy a Lamborghini with a 3% discount, you can speculate and hope that Bitcoin doesn't decrease 10% before you hit the Lamborghini shop. But besides those marginal marketing efforts, we are still far from what we say. And final question is to call something a cryptocurrency. Is it or not, in the legal sense, and you're more qualified than I am to answer that question, is it a misrepresentation? Because according to me, it's not a currency.
Yeah, I mean, I think we all may posit that there are changes, additional enhancements and changes we'd like to add to the legislative structure and the regulatory structure, but working within this framework, which took a large number of years, as you know, to get here, you still have a secondary trading market that is not performing, and I wonder how you react. And my thought to let's wait and see, every year where you have poor performance in these markets is another nail in the coffin. So I'm interested in your answer to the wait and see.
I shouldn't have used the wait, I guess I shouldn't have used the wait and see language. And I guess what I'm saying is we need more, probably need more guidance out of the SEC. And the more that I've actually thought about this, and the SEC, I think, doesn't feel comfortable that it has its arms around everything, because people get confused by the technology, which they really shouldn't. It's just a new technology, and there shouldn't be fear. So I'm at the point where I think when it comes to this whole space, which, you know, there are use cases in terms of capital formation and just reshaping the back office of Wall Street, payments, but then there are non-financial services use cases like, you know, like the supply chain issues, or, you know, protecting IP, like Hollywood is starting to put, you know, every single frame of a movie onto a distributed ledger. So I think we're at a point where it probably takes the leadership coming from the White House or potentially Treasury to bring the agencies together and come up with some kind of things that encourage the technology, but also set some standardization, because what we're really talking about is Internet 3.0. And I don't see, you know, there are other countries that are spending a lot of money in this space, like China, and so I don't see, we have a very robust tech sector, or private sector here, and the technology is changing very rapidly, and so it's good that the US is doing a little bit of wait and see, but I think we are getting to a point where we need probably not just the SEC to be weighing in, but we need, I would say, probably White House or Treasury Department leadership.
So I see we're approaching, or we've reached the end of our time. Are there any brief questions from the audience? Mr. Taubman? Wait a minute, wait for the football, will you?
You know, I'm glad to hear everyone talking about distributed ledger technology and tokenization, but something that Jillian said struck me, and that's that she's not advising clients to look to use Reg A Plus to go public immediately in terms of trading. So that really leaves you at this period where we have, you know, either you're going to do your Reg A Plus or your Reg D or whatever, and you're going to be a non-traded security, and then you're going to wait to get onto NASDAQ or NYSE or whatever your exit is. which kind of strikes me a little bit odd, not you, Jillian, in particular, but, we have.
I am odd, that's okay.
In the past, if I had been at this conference 10 years ago, I would have had in my portfolio of clients, 3 dozen OTC issuers, and they were all regularly doing pipe financings, getting themselves financed, so they weren't getting caught in that trap that you kind of pointed out earlier, that you kind of get stuck being a public company with all the costs but none of the benefits if you start trading. And so this is leading to a question for Dina. I think it's great that the SEC is focused on tokenization and all these great new technologies, but is anybody talking about just simple fixes that would correct a market that's already there? We have over 3,000 companies that trade on the OTC markets, and some of them are very good companies, but there's no at-the-market functionality to Reg A. I mean, you can't really do a pipe off of Reg A because you have to have a set price on resale. There's no concept of an S3 equivalent, and it seems to me that I'm all in favor of tokenization. I have clients working on it, but I would love to see the commission just focus on some simple fixes that could fix what we already have. Is there any type of cognizance of that at the higher levels?
I'm going to go back to, so first of all, I'm on the same page with you as that because I worked on the Jobs Act, and ironically, as this ICO craze was going on, you had Jay Clayton make his 2 speeches, right? One about we don't have enough companies going public, or many speeches, and then he's also talked about the importance of maybe streamlining the exemptions on the private side. So there is some focus. So Jay Clayton immediately expanded the EGC confidentiality provisions to all companies. Now there's a proposal to expand those EGC test the water provisions to all companies. But I think the irony is during this ICO craze, there were 2 things going on, right? This ICO craze, a lot of it is just pent up energy to make the tweaks that you're talking about. So this ICO craze, it goes running as fast as it can. Meanwhile, you got a friendly SEC who was willing to make it easier to raise capital. And I'm not saying that it was written perfectly. You have Congress looking at Jobs Act 3.0. But the industry, a lot of the industry that represents sort of the blockchain, I would say the trading of Ether and Bitcoin space, puts all of their lobbying efforts into creating a new asset class, when really, there's really not much different except for new technology that is going to, it's not, as I said, it's not perfect yet. Some of the news yesterday shows you it's not perfect, but will make things more efficient and less costly in the long run. So I think the SEC's plan and the Capitol Hill's plan was to do exactly what you are talking about. And I had clients, that's what they wanted to do, was let's make changes to existing law, either through regulation or through Capitol Hill. But again, we had some of these groups, and they continue today, they want, just because something is, on a blockchain, or because it's, you're using Bitcoin or Ether, they think we should create a whole new set of rules.
Okay, we have time for one more question.
So I was actually just going to follow up on what you said. I'm Rachel Nussbaum. I'm actually going to be talking a little later, and at the risk of deja vu in the future, I was actually going to talk to Jillian's point. I think you have a very valid point. And I think everybody in this room is pretty well up on updates with Reg A, and since the bill that passed in late January, Reg A for SEC reporting companies actually does behave very similarly to an S3, so it all of a sudden enables OTC companies to do something similar to a shelf offering without having to do a pipe, so it is very similar to that follow-on tendency. I don't know if Sarah Hanks is in the room, but, okay. Well, in what sense?
In that if I have a publicly traded stock and my stock's moving constantly, if I have to do a post-effective amendment to my offering statement, I'm going to miss the market. Whereas with S3, or let's say in the traditional pipe, if I use an S1, my selling shareholders can sell at the market as opposed to at a fixed price that I have my offering price at. If I'm doing an S3, I can price overnight, and I can hit the market where it's at. If the stock's at $6, I can price my deal at $5.75. If I've got to do a post-effective amendment and my stock's moving, I do a post-effective amendment at $5.75, and 2 days later, and I'm waiting for the SEC to respond, and 2 days later, my stock's now at $5. What investor is going to want to buy at $5.75 if my stock's at $5? They'll buy in the market.
It's the inability to do shelf takedowns.
Exactly.
So, and Rachel is at OTC Markets, and she will be speaking later, and you and Lou can go back and forth on this.
Looking forward to it.
As other issues.
No, not at all.
But clearly, OTC Markets has been the haven for a lot of good stuff, and while it's not a complete solution, it's way better than what existed before they did, so.
I know we have to go, but I forgot my business cards, and so if any of you want my contact information, you can just text CROWD to 36260. Don't get all your smartphones out at once, but like 36260 CROWD, because I forgot my business cards. I'm super sorry. Thank you. Bye.
Thank you very much to the panelists, and thank you all.